Hey guys, what's up? Welcome to Fundamental Friday. Hope you had a great week. Today we're going to be talking about the Australian dollar and the New Zealand dollar and how they are correlated. Because if you've been in the market some period of time, you could probably tell that they move very similar, usually in the same direction. And I'm going to talk about why that is and how we can use that to help our trading. So let's jump right into it. First of all, they are correlated up to 93% in the direction they move, which is pretty insane when we're talking about two different currencies being correlated that closely together. Now, of course, it's not always 93%. That is sort of like the average or like the max. Sometimes it could be less. It could be 80, 70, 60. Very rarely are they oppositely correlated. That almost never happens. But yeah, just keep in mind it's not always that highly correlated. But that should give you a good idea of how similar these currencies move. So, why are they so correlated? Well, first of all, they're located in the same area geographically, right? They're both like basically right next to each other, and they have very similar economies, with their primary trading partner being China. They have a lot of trade with China and each other. So if one economy is hurting, likely the other one is too. And that's why they move in a very similar fashion. Now, they also share a status as being risk on currencies, meaning they are perceived as being riskier to own, so they move with risk appetite. Now, in other words, if the world as a whole, if investors as a whole are feeling more greedy and things are going good, then they will move in the same way, but they will appreciate. However, on the flip side, if things are not going well in the world and there's a lot of fear, they will move in the same direction the other way. They will go down. And we recently saw that happening with the whole coronavirus crisis. They lost a lot of value because there was a lot of fear in the market. So for all these reasons, they are very correlated. And also, knowing this information, they're somewhat correlated with the Chinese yuan. I think that's how you say it. Somewhat, not even like close, but they are still correlated with it because they're such close trading partners. Now, when do they move in different directions? When is there a divergence? Because they're not like they don't mirror each other exactly. So really the only times that they show a non-correlation is when there's a divergence in central bank action or data in each country. So the central banks in each country, they decide on interest rates, they release statements, they have an agenda, and when there's a difference between what one country's central bank is doing versus the other, that is usually when we see, sort of a shift, and one becomes a lot stronger or weaker than the other one. Or, like I mentioned, data. So if Australia, their unemployment rate is going up, and New Zealand's looking good, then that will also cause a divergence, and the New Zealand dollar will become a lot stronger. Now, this image here, this was back in November. This is the daily chart for the Australian New Zealand. So right here in November, the Australian dollar, the RBA, which is the central bank for Australia, was expected to cut rates and ease. However, New Zealand, on this big candle here, they held rates and they said, we're not planning on cutting anymore. And so that caused, as you see, a massive shift in sentiment, and the New Zealand dollar became a lot stronger. Now, why is that? Because cutting rates is perceived as bad for a currency. And so if the central bank in Australia says we're going to cut rates, blah, 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 that's perceived as bad. New Zealand is saying we're going to keep rates the same. That's perceived as a lot better. So there's a, divergence there. So that's one way to basically tell if one is stronger than the other. Now, how do we use this to our advantage? Well, once we determine if there's a divergence between the two currencies, if one is a lot stronger than the other, or if it's more neutral and they're about the same, we can use it to help manage risk and find the best opportunities to trade. So let me elaborate a little bit more on that. If one of these is stronger or weaker than the other, like let's just use this example, if the New Zealand dollar is a lot stronger than the Australian dollar, then we know to pair the New Zealand dollar with a weak currency since it's so strong, right? And that'll give us a good opportunity rather than pairing the Australian dollar with a weak currency, because then they're both sort of weak and that won't be a very good trade. It'll chop around and there won't be a trend. So we can use it to our advantage doing that, but also knowing how correlated these two are, we can use it to manage risk, right? So we know they normally move in the same direction, except for a few instances. So not opening more than one or two positions on either the Australian dollar or the New Zealand dollar will help you manage your risk. Let's say you have two positions on the Australian dollar and two positions on the New Zealand dollar, whether it's with the euro or the dollar or the pound, whatever pairs you're trading, you are exposing yourself more than you would if you were trading, let's say, the Australian dollar and the Canadian dollar or the yen, right? Because chances are, if you're looking to trade them either in the same direction or different directions, it's not good, right? Because if you're looking to trade those pairs all in the same direction, instead of four different positions, four different pairs, really you're sort of taking one really big position because the Australian dollar and the New Zealand dollar move in the same direction. So if one of them, their stop gets hit, likely all four of them will. So that will help you not over leverage. And two, if you're trading them in different directions, you know that that's probably not a good idea because they move the same way. And essentially, you're basically net zero if you look at it that way in your positions, right? It's sort of like shorting the dollar and then buying the dollar, right? It doesn't make any sense. What you wouldn't, bet on something going up and also going down at the same time. But essentially, that's what you would be doing if you were, long a pair with the Australian dollar and short a pair with the New Zealand dollar. So knowing this, we can make smarter trading decisions, manage our risk better, and overall just have a better understanding about, correlation and how different things move. Touching on the whole, risk on, risk off, the same thing we see with these two currencies and the Japanese yen, which is a risk off currency. We see they have an almost exact opposite currency correlation. And so, we can use that to our advantage as well. But anyways, guys, I hope you enjoyed this video. Hope you learned something from it and, implement this in your trading somehow. I will see you guys on Tuesday. Have a great weekend and, stay safe. Peace.